Hey guys, Griffin Cooper here from Ableway Tech, and today I want to talk about how to avoid one of the biggest trading mistakes. I was talking the other day to one of my friends who's a trader, and he was exasperated, he was struggling, and as I talked to him to kind of figure out what was going on, I realized that he was trading without using stops. And to me, this is one of the biggest trading mistakes you can make. And so today I just want to talk about stops. We're going to talk in this video about what is a stop, how stops are the biggest separator between amateur and professional traders, why people don't set stops, kind of some trading psychology, the dangers of trading without a stop, and then the benefits of trading with a stop. And we'll even go through an example of a pattern from our Kata Challenge in the Applied System Development course that shows exactly how we set stops using price action and specific indicators. So let's dive in. So let's first talk about just what is a stop. A stop is simply a worst case exit point. It's the price where you know that you'll exit the trade, and here's the important part. It's set before you put the trade on. And it's called a stop for a reason, because stop is the place where you'll stop losing money if the trade isn't going in the direction that you traded it. And the thing about stops is they apply to all time frames of trading. It doesn't matter if it's a daily, a monthly chart, or a minute or tick chart. It applies to all time frames. It applies to all types of financial instruments, from Forex to stocks to crypto, especially crypto. So stops is, again, simply a worst case exit point where you know that you'll exit the trade. And the really important part to remember is that the stop is set before you put your trade on. The next point I want to make about stops is that stops, or any process that you have to cut your losses, is really, to me, the biggest separator between amateur and professional traders. There are different ways to do this, and the way we do it, our methodology is to use stops in the market when we put on a trade. Different professionals use different ways of cutting their losses, but we found the best way to do this for our kind of trading is to use stop orders in the market. This goes along with the idea that we talk about a lot in the Applied System Development course, that we find the movers. By finding symbols in a critical state, we are more poised for a large move in either direction so that we don't get chopped up in sideways markets. The psychological part of this is that we don't believe in the trade. We have a saying we use here, and that's you don't have to be right, but you can't stay wrong too long. And there's a great series of books by Jack Schwager called Market Wizards, and he interviewed all the best traders. And one thing they have in common is they all had a way of knowing their risk and cutting their losses. And again, the way we do this in the Tortoise community of traders and the way we teach in the Applied Systems Development course and the Kata Challenge is to use stops in the market. The next thing I want to talk about is why people don't use stops. And this is really about trading psychology, probably the most important part of this video. And the reason that I think people don't use stops is because they're mesmerized by the possibility for huge profits. They're not thinking about the possibility of losing money on this trade. And really what that comes down to is that they believe they know what's going to happen next. And the thing is, this is a really dangerous way of thinking when you're trading, because the truth is that anything can happen in the markets. It doesn't matter how good your technical analysis or your system is. It only takes one trader to move the price against you in an instant. So the reason people don't use stops is because they think they know what's going to happen next. And the truth is, you never know. Anything can happen in the markets. Now let's talk about the dangers of trading without a stop, and then the benefits of that you can enjoy when you trade with stops. So first, the dangers of trading without a stop. The biggest thing is that your loss potential is unlimited, because if you don't have a place you're going to get out when you put on the trade, you never know how far it's going to go down, what could happen in the markets. So really, you're making your loss unlimited. And the way a lot of professional traders you'll talk to is that they believe there's always a trade, with your name on it that can wipe you out. And I know this from experience. When I was first learning to trade, I was trading credit spreads, and I put on a trade for American Airlines, trying to make a grand, and went out for a jog. And by the time I came back, I didn't put a stop in. And by the time I came back, I was down over five figures. And that was the first time that I realized, how important stops are to protect your capital. And I don't want that to happen to you. A good metaphor that people use for trading without stops is that it's like driving without stopping at red lights. And it'll work for maybe a little while, but eventually you're going to have a huge collision, which is basically a huge loss when you're trading without stops. Now, the benefits of trading with a stop. The biggest thing here is that you always know exactly what your risk is. So you're essentially cutting your losses. And that means you're following the first part of what we call the golden rule of trading, which is to cut your losses and let your profits run. Another huge benefit about when you trade with stops is that you can start evaluating, assessing, and improving your trading results based on the amount of risk you're taking, or the R multiples. And we don't have time to get into R multiples in this video, but when you're using them and when you're trading, looking at your trading results based on the risk you're taking, then you can compare your trades across any section of symbols, whether you're trading gold or the Aussie dollar or Tesla. You can compare your results across different time frames, from a daily chart to a 3-minute chart, and across different systems as well, to see which systems are performing well. And when you start to do this, now, my friend, you are thinking like a professional trader. Now I'd like to just go through an example of what this looks like in application, because for me, the only way I can learn is through doing. So here's an example of how we did this in the Kata Challenge, which is part of our Applied Systems Development course. And everyone in our Tortoise community of traders, this is how they all set their stops. And the great part is it's simple, it's easy to understand, it's based on price action, technical analysis, and it uses specific indicators tuned to statistically significant turning points. So here's an example of our supported spring crossing pattern. And this is on a daily chart using EWZ, the Brazil ETF, which is one of our favorite trading vehicles. We used it exclusively in the Kata Challenge. And you can see the green dot is where we bought and got long. But what I really want you to pay attention to is this big red line, because that is where we put our initial stop loss in the market at the same time we executed the trade. We use a special version of the parabolic stop and reverse, the PSAR indicator, and moving linear regression lines to find the specific point that is statistically and mathematically significant to show us when our trade is not working and we can get out and cut our losses. This is just one of the 3 basic patterns we teach, but we do this on every trade. So to review, in this video we talked about what stops are. They're the price, the place where we have designated as our worst case exit point and that we have established before we put on the trade. We talked about how stops are the biggest separator between amateur and professional traders. We talked about why people don't use stops and why that's not a useful belief in our trading psychology. Talked about the huge dangers when you trade without a stop and the massive benefits that you get when you're using stops. And we went through an example of what that looks like in application using one of our basic patterns from the Kata Challenge, the supported spring crossing. So, stops are essential for cutting our losses, but that is only half of it. We need to have a plan for letting our profits run. That's the second part of the golden rule of trading, is to let our profits run so that we can make some money. So the example we showed was one of the 3 patterns we use to trade that are taught in the Kata Challenge in our Applied Systems Development course on ablewaytech.com. And in that course, we give you lots of different exit strategies that you can use to have a way to systematically and effortlessly exit winning trades so that you can get paid and be satisfied with your trading. Also, the charting examples shown here, including our specifically tuned PSAR, is part of our OWL bundle for thinkorswim, and that's also available at ablewaytech.com. And in the Applied System Development course, we show you how to set up these indicators on any platform. So go to ablewaytech.com for more information and to enroll in our course. And please leave a comment if that was helpful, and also let us know any other questions or obstacles you guys are struggling with and that you'd like us to address in our next video. Thanks for watching.